Hello friends, today we're going to be talking about what is the short-term rental tax loophole. What is this short-term tax rental loophole? Stay tuned because by the end of this video, you're going to have a pretty clear understanding of what the short-term tax rental loophole is and how it can save you thousands of dollars in taxes. Knowing this will empower you to make better financial decisions when it comes to investing in short-term rentals. Have you ever wondered why short-term rental operators potentially pay less in taxes than other real estate investors? So stay tuned as we unravel the mysteries of the short-term tax rental loophole and how it works for you. And I'm going to start off first by diving into what is the short-term rental tax loophole. Second, I'll explain the tax benefits of this loophole. And last but not least, I'll cover the steps that you need to take to benefit from this tax loophole. If you're ready, let's go. So what is the short-term rental tax loophole? If you were to ask anybody why they get involved in real estate, one of the answers usually always is to take advantage of the tax benefits that are included in owning real estate, especially people that do real estate on the side. They might have a business, they might be a doctor, they might have some other profession, but they buy real estate because owning real estate, there are certain tax benefits that go along with owning real estate that you can't get anywhere else. And owning those pieces of property are going to help you write more off on your taxes to help you pay less in taxes overall. And smart people understand that, and that's why real estate investing has been one of the #1 ways ever to build wealth, and it continues to be just that. And when it comes to tax savings, the short-term rental tax loophole might be one of the coolest. So this short-term rental tax loophole, sometimes called the Airbnb loophole, it's a strategy that real estate investors can use to help mitigate their rental income tax by offsetting earned income with real estate losses. There are other ways to participate in this loophole, but you have to be considered a real estate professional. But most people like myself don't fall under the category of being a real estate professional, and this is why. To be a real estate professional, you have to put in at least 750 hours a year, and 50% of your service has to be in the real estate trade or service industry. So for most of us, that's not realistic, especially if we're doing real estate on the side. So a short-term rental is deemed a rental activity if a person stays there on average 7 days or less. Now that doesn't mean that somebody can't stay for longer than that, even stay for 2 weeks. It's just all the stays combined in that year have to average at least 7 days or less. However, it is not classified as a rental activity, but rather as a business, treating all income and expenses from the property as active income. And if you look at this compared to long-term rentals, where long-term rentals would be passive income, this is really where short-term rentals shine. It was originally designed for hotels and hospitality. But there is a section of the Treasury regulations that outlines 6 exceptions to the rules defining rental activities. The average period of customers staying there has to be 7 days or less. And for most short-term rentals, that's easy. That's one that we all qualify for. Investors in short-term rentals do not necessarily need to meet the qualifications of a real estate professional to reclassify their passive real estate losses. They only need to materially participate. So what does material participation mean? So this is where it gets fun. So some of the definitions in the tax code can render losses non-passive for short-term rental investors that meet one of the 7 qualifications. These tests assess your level of engagement and involvement in your short-term rental property and ultimately determine your eligibility for this tax advantage. And here they are. Number 1, spend 500 hours or more on your short-term rental business. Now this is the one that most people will qualify for. If you are self-managing, there is no doubt that you're spending at least 500 hours a year on your short-term rental property. Think about it. Every single day you're probably answering questions, right? And if you think in 500 hours, let's say you average every day of just 2 hours a day. And if you did 2 hours a day with all the different things that you do over the course of a year of 365 days, you're looking at over 730 hours of participation. Now, if it's 1.5 hours, you're right there at 500 hours, right? So most people definitely fall into this category. I know that I do. Number 2 is do everything substantially for your short-term rental business. This means you don't have an outside group doing it or cleaning. That might be a little bit harder to do. The third one is spend more than 100 hours on the activity with no other individuals surpassing that time that you put in. So here's the 4 other things that I actually want to read directly from the tax code. Number 4, engage in significant participation activity for more than 100 hours with your combined activity and all other significant participation activities exceeding 500 hours. That's difficult to do. Number 5, participate in the business for 5 of the previous 10 taxable years. Most people haven't owned some of their short-term rentals for more than that. Number 6, engage in a personal service activity for 3 of the previous taxable years. And number 7, demonstrate regular, continuous, and provable participation in the business for more than 100 hours. Now, I know that's a lot to swallow, but typically the top 3 that I mentioned initially are the ones that most short-term rental owners and self-managers fall under. And remember, you only have to meet one of the 7 criteria. So once again, this is where I'd recommend getting a good CPA to help you out in this. But just knowing that you could qualify for this is absolute gold in helping save you money. Because if you have any losses, these can offset your ordinary income. And that's what most people try and do all the time in the business world. So once you get your CPA, the first thing you're going to want to do is a cost segregation study. Now, what is that? And once again, because we're talking about tax stuff, I'm going to read it right from the tax book. So cost segregation study aims to reclassify specific components of your property, transitioning them from a 39-year life, the standard depreciation life for a short-term rental property, to 5 and 15 years. This applies to tangible personal property, land improvement property, and qualified improvement property. The power of this strategy lies in the fact that 5 and 15-year property components typically make up 20 to 30% of the property's purchase price. That's pretty amazing when you think about it. Let's give you a quick example. So let's say that you own $1 million property and you go under cost segregation to 20-30% of the property. So if you could re-segregate that and do a substantial deduction of $200,000 to $300,000, this is powerful because your losses are non-passive and they can be used to offset your income. Imagine being able to offset $200,000 to $300,000 off your ordinary income because of the cost segregation and the short-term rental tax loophole. Now, please note that 2022 was the last time you could do 100% of that 20 to 30% cost segregation. 2023 allowed 80%. This year, 2024, they're allowing 60%. 2025 is 40%. 2026 is 20%. And by 2027, the bonus depreciation is scheduled to disappear and stick to the current plan. There are chances that there could be extensions or people might challenge this to extend it even further. But it's important to realize that the short-term rental tax loophole isn't under threat and it will remain intact. It's just that the 100% bonus depreciation is naturally phasing out by 2027. And even though those bonus depreciations are phasing out, there remains opportunities to depreciate your property at 5 and 15 years rather than the standard 39 years, which is also crucial when saving on taxes. In conclusion, there is some power by owning short-term rentals, and taking advantage of the short-term rental tax loophole is amazing. But once again, get a good CPA who can help you navigate these waters, because that isn't my expertise. As I mentioned, my expertise is to be dangerous enough to help you make empowered decisions to save you money and take advantage of this beautiful thing called real estate. And this has been my experience. I actually love getting involved in short-term rentals and I love investing in real estate, but I'd be interested in your feedback. What tax advantages have you seen that have you taken advantage of in your own real estate investing that have helped you? Comment below. Let's engage in a dialogue. And as always, just for stopping by, you get access to my free gift, a short-term rental calculator. Put in all the income, all the expenses, and it will spit out to you whether it's a good deal or not. It's 100% free. Just click on the link below, aaronsfreetraining.com. Thanks for stopping by. Have an awesome day.